What's up, everybody? John Gray here, and I wanted to talk to you about our financial plans for 2017 going into the new year. A couple things have changed, a couple things are going really well, so I just wanted to talk through a little bit of that. And the first thing I wanted to talk about quickly was our wedding decorations. So I wanted to quickly just show you one of the things we're doing to save money is we're making our own table placement decorations. And this is what one of them looks like. So as you can see, it says, "Marriage is like a walk in the park, Jurassic Park." And we're putting little funny and cute quotes like that on these boards, which will sit on each individual table at dinner. So yeah. But other than that, everyone's sort of planning, what the layout for the wedding will be, each step, who goes where, when, and all of that. There's a lot of little tiny things, in a wedding that you just don't think about until you have to plan your own wedding. So, we're going through that, but it should be a good day. Our wedding is relatively simple. We're not spending, a whole lot of money at all. So I think we're more interested in just the celebration aspect of it than, all the little frills that'll actually represent the little things where, it's more about us than all of that anyway. So yeah, that's our wedding. And then a couple of things have changed since the last time I talked about what our house plan was. So we're currently in an apartment, as many of you know, and we just became debt free. So we're saving a lot of money right now for a home. The initial plan was to save for the next 2 years and have about a 50% down payment on a $200,000 house, something like that. And that changed for us over the past 3 or 4 months as we talked about, what a $200,000 house would buy us. So as many of you know, whoever's, gone through the pre-approval process or looked at homes and looked at what a mortgage would be, as many of you know, they are willing to loan you, like the mortgage, whoever does your mortgage, a lot of times they're willing to loan you a lot more than you're probably comfortable with. So people in our income bracket, it seems like, who have decent credit, it sounds like they'll loan us like $400,000 to $500,000 for a home. So that's nowhere near like the level of home that we need for two people. Let alone the payment that would come with that. It's just so unbelievably mind-boggling that anyone would give people who make what we make, under $100,000 a year, that amount of money for a home. And it shows obviously how people become house poor so easily, because they get that money and then they have a payment that's more than 50% of what they actually take in. So we decided that we were going to look in the $200,000 range because that was what we were comfortable with, and we knew that we could pay that off, the remainder of the mortgage, we could pay that off within 5 years or less. So we thought, very easily we should be able to get that done and squared away, no mortgage by the time we're 31, 32. But as we started to look at the homes in our area and surrounding areas that we were comfortable with living in, what you get for $200,000 is not bad, but it's not great either. So I was having a hard time, and I think Danielle was too, justifying putting so much money down for a home that still needed additional work. Things like, not huge things, but like cabinets and kitchen, the appliances, everything is super, super outdated. Rugs and things like that needs to be replaced. So nothing that would require you to tear down a wall necessarily, things you could probably live with, but things that we didn't feel like we should have to live with considering that we're gonna put down this much money. So what we decided on instead of a $200,000 house was looking at areas that had either foreclosed homes or maybe like fixer-uppers, so where the area is selling around the $200,000 mark for home value, but the homes that are being foreclosed on, they're going for maybe $65,000 to $85,000. So what that does is two things for us. It allows us to purchase a home in an area that's still good and up and coming and will allow us some growth, but the price is drastically reduced because the bank is, trying to get rid of it, or, it does need some work that a lot of people aren't willing to do. So the bank's willing to let go of it from a lot less. And my dad was actually a contractor, and he's done many home improvements, and I've done a couple of them with him on our own home when I live back home. So I'm very confident that we would be able to do that. So that allows us to get a home for roughly less than half the price of what we were thinking before. We could probably put $30,000 to $40,000 into it, plus our down payment, and still be all in on the house for maybe just over or just under $100,000, and have the value of the home, be exponentially greater than where it started, because we took the time to do the work and fix it up. So the new plan is to save for the entire year of 2017 and use that money as our emergency fund and our down payment on this sort of foreclosure fixer-upper type house, and then take out a mortgage on the remaining amount. But that would only be for the remaining cost of the home, plus the repairs we're talking about doing. So just the starting of the repairs, not everything. And that would total, our mortgage would probably be around $75,000. But if anything else comes up, we can cash flow it by that time, because we're putting all of our extra money into this house to get it paid off so that we own it. What that allows us to do, in opposed to the other plan that we were thinking about, is it allows us to pay off the home a year faster. So we could get that house paid off in 2 years versus 4 or 5, or so maybe 2 or a couple of years faster. And it allows us to have a home by the end of it that is everything that we wanted it to be in the first place. So I think the problem that we were having with the $200,000 house was trying to justify a home that we're going to have to continually fix up even after we've put that much money into the mortgage. And we decided at the end of it, it wasn't worth it. We might as well start from scratch with a home that doesn't cost very much, deal with the problems that it needs to have fixed, and then take it from there. Now, I don't necessarily recommend that everyone do this. Fixer-uppers can be, a big pain in the butt. A lot of unforeseen things with structure. So there's a lot of things you have to be really careful about, right? So to make sure that, you're not digging yourself into a hole. So right now I'm doing a lot of research on the homes that we actually see to, see if there's anything I can get from, just information perspective on the history of the home, or, did it have any, major problems, like was there a fire where, all the structural beams are completely decayed and that's why they're selling it for a small amount of money. I don't want us to go into that kind of scenario. So I think as long as you sort of do your research and make sure you're careful, and you're willing to put in the work, you can, get a home for a relatively cheap price and, have it look the way you want to for a lot less than it would cost for you to just borrow the money from the bank. So that's sort of our plan for our home. Then after we get our home paid off, and by that time we'd be about 29, 30. We're about to be 26 this coming year. We're looking to get into rental properties. And I'm going to do a video on that and, my thought process behind how we should go about doing rentals. It's very similar to the way, Dave Ramsey would, give you advice on rentals. I'm not one who is big on taking risk for rental properties, so I'll talk a little bit more about that in a future video. But my thought process is that I want to start putting my money in places that will start building residual income, so that we can have income coming in where we just sort of maintain the properties, but still have income coming in that's outside of the 9-to-5 jobs that we have currently. And I think that's what will be the key going forward for building wealth. And some of those things might change. I mean, I don't know. That's just sort of the hard outline for the next 5 or 6 years. I'm really motivated by the whole being debt free and being wealthy piece of it, but also the retirement thing. So for me, I don't want to work. I don't want to still be working when I'm 60. I want to retire well ahead of 60. Ideally like 50. Now that's a lofty goal, considering the financial climate and how people are using their money right now. But I'm willing to put in the work now, and I know Danielle is too, to get there, so that we can just enjoy life after that. I don't want to be a burden on anyone else, and I also want to leave a legacy for my children, to put them in a place where they're starting way ahead of where I could have ever thought was possible. And I'm starting to do the math, and it's very possible if we just commit and do the work. So that doesn't mean I'm not going to enjoy life between now and 50. We're obviously going to do a lot of fun stuff between now and then, but we're going to be very strict on the things that we do and don't do. So I know a lot of people will probably, listen to this video and say, you're going to, throw your whole life away, your 20s, your best years, and your 30s, you're not going to have any time for family. Is that really going to make you happy? Yes, it will, because when I'm 50 and my kids are just having kids, or I don't know, what part of life they'll be on. But when I'm 50, I won't be working, and a lot of people will. And my grandchildren will not have to worry about going to get a student loan from Sallie Mae because their family didn't prepare for, their future. That's what's important to me. And I enjoy this process. A lot of people don't get that part of it, but I enjoy budgeting so that I can see the money in my account. I enjoy budgeting so that I can dream about the things that we're going to do in the next 5 years, which for a lot of people are just completely beyond anything that they would think is possible. So I enjoy that piece. So that's my 2017 plan, and I'm actually super excited about it. Danielle and I have had some really good conversations where we've just sort of dreamed about, the amount of money we have. We're also going to start putting 15% of our income away for retirement next year, probably right around June or July. So we'll have that money too. This is all very on purpose. This is very intentional, and us talking about what the future could look like is getting pretty exciting. So if anything, I think I'm sharing a lot of this after the whole debt-free journey is done, because I want other people to sort of think about where they want to be. The plan can't just be to get out of debt and then spend it all on cars and jewelry and things that won't matter in 10 years. I want people to be able to build a legacy and to think about it today. So no matter what age you are, I'm hoping that you're thinking about 2017 with a lot of optimism about your financial goals. And comment below if you've got some similar lofty goals that you're trying to reach in 2017. I like hearing about where other people want to be too. It motivates me to keep going. So thanks everyone for listening, and I hope you have an awesome year. Let's get it done. Thanks.